Interest rates are on the rise. The Bank of Canada has already increased interest rates twice this year, but what does that mean for you?
This morning, we raised our policy rate 50 basis points to 1%, and we indicated Canadians should expect further increases.
Interest rates affect real estate in three major ways. The first one is if you own a home and you're paying a mortgage on it. The second one is if you are looking to buy a home and you're looking to get a mortgage. And the last one, of course, is the value of a property, whether you're looking to buy or looking to sell. So first, just a quick brief on what happens when the Bank of Canada increases the interest rates and you hear one of those news announcements. Well, the Bank of Canada is actually increasing what's called the overnight lending rate. This is the rate at which the Bank of Canada loans money to the big banks and the lenders, which they can then use to loan to you. The banks will then take that rate at which they're receiving money, they will add a premium based on risk tolerance and come up with what's called a prime rate. Banks and lenders can choose how they want to determine that prime rate, but because there is competition and you could go to any bank or any lender, they do tend to be fairly similar and very close to each other in rates. And typically they tend to be around 2 to 2.5% above that overnight lending rate. That prime rate is then either discounted or there's a premium added to it, and that is the basis or the benchmark for the different kinds of products that you get from your lenders. So now, if you are paying a mortgage right now and you do have a monthly payment, what happens when these rates go up? If you have a fixed mortgage, absolutely nothing happens. That's why you got a fixed mortgage. Essentially, until the end of that term, nothing will change for you and you are locked into that rate. If you have a variable rate mortgage, you will see a change. Either your overall monthly payment will go up or the interest portion of your monthly payment will go up. And so the payments will stay the same, but the amount of principal in proportion to interest will go down. So now what if you're looking to buy a home and you need to get a mortgage? What does this mean, or what do these increases mean if you're looking to get a fixed mortgage? Well, the rates are just going to be higher. Fixed rate mortgages will continue to go up, but it's going to be more gradual because it's tied to the bond market. So it will move up based on the economy and based on market conditions rather than right there when an interest rate increase is announced. Variable rates, on the other hand, will move directly tied to that interest rate. So if, for example, the Bank of Canada raises interest rates by 0.5%, all of a sudden you're going to see the rates for a variable rate mortgage increase by 0.5% as well. So now what I think is the most important question that I get is, what is this going to do to the market and the price of homes? There's one important thing that it comes to when applying for a mortgage, and that's called the stress test. This was put into place in order to prevent the Canadian market from crashing or collapsing because people couldn't pay their mortgages. So they do have to qualify for their mortgage at a higher percent than what they're actually getting. Right now, that rate is the higher of 2% above the quoted rate or 5.25%. How this plays into what's going on right now is fixed mortgages are hovering around 4% right now, with variable around 2.5%. So if you're looking at a variable rate mortgage, you're not going to see any change in the stress test because you're still going to qualify at that higher 5.25% rate. However, if you're looking at a fixed rate mortgage, which are going for around 4% right now, you would need to qualify at that higher rate, which is 2% above the quoted rate, so around 6%, which is higher than that 5.25. What that's going to do is lower the overall mortgage amount, which will lower people's budget, which then puts some pressure on the demand side, and people just don't have as much money to spend on their home. That's one of the biggest things that's going to impact the market is as these interest rates go up, we're going to start to see that stress test pushed higher and higher, so people's budgets are going to come down. Now, the other major effect that interest rates have on real estate and buying and selling is that borrowing money is just more expensive, and it takes more money out of your pockets, it takes more money out of your monthly income, and therefore people just don't have as much to spend because they're paying more on their monthly mortgage, they're paying more on their expected mortgage payments, and they're paying more on any other loans or financial products that they have. So as qualifications start to get a little bit tighter and the cost of borrowing increases as well, we're going to see that there will be an impact on the price of homes, and we're already starting to see that. So do I think that the market is going to collapse and that we're in a huge bubble? I don't think so, because most people that are buying homes are buying them to live in them, buying them because they need them, rather than just purely as an investment. However, with these increases that are coming out, we are going to see that put pressure on the market and start to stabilize it and bring down prices as well with it a little bit. To what extent, we'll have to watch and see. and it depends on how big they do go about making those increases. If they are significant, we start to move up really quickly, that's going to make a much more drastic impact rather than if they start doing it a little bit slower. If you found this video helpful, click on the like and subscribe. I'll make sure to keep you updated as we get announcements from the Bank of Canada. And if you'd like to know the impact on the value of your home, or if you're looking to buy a home, leave me a message. I hope you have a wonderful day. I'll see you soon.